In a market where more than 700 million ounces of paper silver trade daily against less than 30 million ounces of registered physical supply inside COMEX vaults, something fundamental is no longer aligned. Not gradually, not over years, but in compressed bursts of volatility that appear in days, sometimes hours. They said modern futures markets eliminated the risk of physical stress. They said liquidity solved scarcity. And yet, in 2023 and 2024, registered silver inventories on COMEX fell below 30 million ounces, while open interest hovered near 150,000 contracts, representing exposure to over 750 million ounces of silver. That is leverage at a scale most investors never visualize. Here's the part that shifts perspective. Global silver demand reached approximately 1.24 billion ounces in 2023. So, industrial demand alone accounted for more than 55% of total consumption. Solar panel production consumed over 160 million ounces, a record high. Meanwhile, the Silver Institute reported a structural supply deficit exceeding 140 million ounces for the second consecutive year. Physical demand is expanding, paper exposure remains massive, and inventories designated as immediately deliverable remain historically tight. Institutions understand this dynamic long before headlines mention it. Futures markets reflect positioning. Physical markets reflect need. When those two drift apart, tension builds quietly. What I'm about to show you is not speculation. It's pattern recognition based on data. Welcome to Capital Signal, where we decode what matters before it becomes consensus. This channel exists to examine the underlying mechanics of markets, inventory flows, institutional positioning, regulatory filings, before narratives solidify. If you value calm, data-driven breakdowns, you're in the right place. And as always, comment where you're watching from. The global nature of this audience mirrors the global nature of the silver market itself. Let's begin with what actually happened. Throughout 2023, COMEX silver registered inventories declined from over 40 million ounces to below 30 million ounces at certain points. Registered metal is what's immediately available for delivery against futures contracts. Eligible metal, often above 250 million ounces, may sit in vaults but is not committed for delivery unless owners convert it. That distinction matters. At the same time, the open interest frequently fluctuated between 140,000 and 160,000 contracts. Each contract represents 5,000 ounces. At 150,000 contracts, that's 750 million ounces in paper claims. Compare that to 30 million ounces registered. The coverage ratio tightens dramatically. Normally, futures markets operate with fractional physical backing. Delivery rates are typically low. Most contracts cash settle or roll forward. That's standard practice. The abnormality emerges when physical drawdowns accelerate while paper exposure remains elevated. Now layer in global demand. In 2023, total silver demand reached roughly 1.24 billion ounces. Industrial demand alone consumed over 700 million ounces. Solar manufacturing required more than 160 million ounces, driven by expansion in photovoltaic capacity, particularly in China. Electric vehicle components, electronics, and grid infrastructure added further pressure. This isn't discretionary jewelry demand. This is industrial dependency. Here's where it gets interesting. Mine supply has not kept pace. Global silver mine production remained under 850 million ounces in 2023. Recycling contributed additional supply, but total availability still fell short of total demand. The result, a structural deficit exceeding 140 million ounces. In a typical commodity cycle, persistent deficits trigger visible price adjustments. But silver's price behavior has remained comparatively restrained relative to deficit magnitude. That divergence raises a question: where is the balancing mechanism? To understand that, we look backward. In 2011, silver surged from under $20 per ounce in 2010 to nearly $49 in April 2011. The setup included heavy futures speculation, expanding industrial use, and tightening physical supply. COMEX inventories were strained, open interest ballooned, then margin requirements were raised multiple times within weeks. Liquidations followed, price collapsed. In 2008, during the global financial crisis, silver fell sharply alongside other assets as liquidity evaporated. But within 2 years, it more than tripled in price. Why? Monetary stimulus, renewed industrial demand, and constrained mine output converged. In 1979 and 1980, silver spiked amid inflation fears and concentrated physical buying. Futures markets expanded rapidly relative to deliverable supply. The result was extreme volatility. After regulatory interventions and position limit enforcement, price retreated dramatically. Different decades, different catalysts. A same structure, expanding leverage, tightening physical availability, regulatory response, volatility. Now consider 2020. During pandemic disruptions, physical silver products experienced widespread shortages. Retail premiums soared. Futures pricing briefly disconnected from physical availability. COMEX adjusted delivery mechanisms to maintain order. Inventories fluctuated rapidly. The pattern is not that silver always explodes upward. The pattern is that when physical tightness meets heavy paper positioning, resolution comes through repricing or forced adjustment. Let's examine the players. COMEX operates under CME Group oversight. Margin requirements adjust based on volatility metrics. In periods of rising price movement, initial and maintenance margins increased. This forces leveraged participants to either add capital or reduce positions. That mechanism influences price trajectories. Bullion banks act as market makers. They hedge exposure across futures, options, and over-the-counter derivatives. Large commercial traders often maintain short futures positions to offset physical holdings or forward sales agreements. When inventories decline, hedging dynamics shift. Major vault operators, including JP Morgan and other institutional custodians, manage registered and eligible stocks. Transfers between categories occur regularly. When eligible metal is converted to registered, deliverable supply increases. When registered declines without conversion, tension builds. Meanwhile, global flows matter. China imports significant silver for solar production. India periodically increases bullion imports during industrial and investment cycles. Exchange-traded products hold hundreds of millions of ounces combined, creating another layer of demand. In 2023, exchange inventories outside the US also fluctuated. London vault holdings experience periodic drawdowns. While not identical to COMEX stocks, global vault flows influence arbitrage opportunities between markets. Timing matters. When industrial demand surges in Asia while Western futures markets reflect heavy speculative shorts, pricing dynamics can appear contradictory. That's not conspiracy, that's structural segmentation. Here's the dislocation. Futures pricing often reflects macro sentiment, interest rates, dollar strength, risk appetite. Physical demand reflects fabrication need. In 2023, the US. Our dollar index strengthened relative to prior years. Rising real interest rates pressured precious metals broadly. Futures traders responded accordingly. But solar panel manufacturing did not slow proportionally. Global photovoltaic installations reached record highs. Silver paste consumption remained elevated. Industrial buyers are less sensitive to short-term rate movements. They purchase based on production schedules. So you have paper markets reacting to monetary policy and physical markets reacting to manufacturing expansion. Two different signals, one price. Premiums on certain physical products occasionally widened, even when futures prices softened. That gap quantifies the divergence between immediate availability and financial positioning. Why can't that gap persist indefinitely? So, because futures contracts ultimately derive legitimacy from deliverability. Even if most contracts never settle physically, the option must remain credible. If registered inventories shrink too far relative to open interest, either inventories replenish, open interest contracts, or price adjusts to rebalance incentives. Let's examine the mechanism. Imagine a warehouse issuing receipts for grain. As long as most holders trade receipts rather than demand grain, operations remain smooth. But if grain inventory declines while receipt issuance stays high, risk increases. Either more grain arrives, fewer receipts circulate, or the price of grain rises enough to reduce demand. In silver's case, margin policy is the lever. If volatility increases, CME raises margin requirements. That reduces leverage. I reduce leverage forces weaker hands out of positions. Open interest contracts. Pressure eases. Alternatively, higher prices incentivize recycling and marginal mine production. Over time, supply responds, but mining is capital-intensive and slow to adjust. New projects take years, not months. Another lever is inventory reclassification. Eligible metal can convert to registered if owners choose to make it available. That decision depends on price incentives and contractual obligations, so the system has release valves. But each valve carries consequences. Now, forward analysis. Historically, persistent structural deficits in commodities resolve through either sustained higher prices or demand destruction. In 2011, silver resolved upward before regulatory tightening reversed momentum. In 2008 to 2011, stimulus and industrial expansion drove multi-year gains. If global solar expansion continues at its current trajectory and industrial demand remains above 700 million ounces annually, while mine supply remains under 900 million ounces, deficits persist. Historically, multi-year deficits compress above-ground stocks. If COMEX registered inventories remain below 40 million ounces while open interest stays near 150,000 contracts, coverage ratios remain tight. Historically, such setups increase volatility probability. Watch specific indicators: registered inventory trends, open interest levels relative to inventory, solar installation growth rates, exchange-traded product inflows or outflows, margin requirement adjustments. These are not predictions, they are stress gauges. There are several scenarios. In a conservative path, saw inventories gradually rebuild through higher recycling and modest price increases. Open interest declines as speculative excess unwinds. Volatility remains contained. In a moderate scenario, industrial demand accelerates while investment flows re-enter precious metals amid macro uncertainty. Inventories tighten further. Price volatility expands. In a more aggressive historical parallel, concentrated short positioning meets sustained physical demand. Margin adjustments trigger forced covering. Price reprices rapidly before stabilizing. No guarantee, only precedent. Now the divide. Those who monitor only price charts see noise. Those who track inventory classifications, demand breakdowns, and institutional positioning see structure. It's not about predicting an exact number, it's about understanding pressure points. Our institutions analyze warehouse stocks weekly. They evaluate open interest ratios daily. They assess fabrication demand quarterly. Retail participants often react to headlines after moves occur. Information asymmetry creates timing differences. Timing differences create opportunity gaps, not because one group is smarter, because one group watches plumbing while the other watches headlines. Silver sits at the intersection of monetary perception and industrial necessity. That dual identity creates complexity. Complexity creates misunderstanding. Misunderstanding creates mispricing. When over 750 million ounces trade on paper against a fraction of that in immediately deliverable form, while global industry consumes over 1 billion ounces annually, tension exists. Whether that tension resolves through higher prices, policy adjustments, inventory shifts, or some combination depends on which lever moves first. But the pattern is clear. Structural deficits do not vanish quietly. Coverage ratios matter. Industrial acceleration matters. Margin policy matters. This is Capital Signal, where we decode what matters before it becomes obvious. If this connected dots that weren't previously aligned, you know what to do. The question isn't whether silver's structure evolves. The question is whether attention is placed on the data before the adjustment arrives.